What's up guys, it's your Money Cat here. Thank you so much for joining me today. In this video, I'll be explaining the option Greeks, especially in relation to day trading options. It'd mean a lot to me if you'd like the video and subscribe for more content like this. Thank you so much. In this video, I'll be talking about the main four Greeks of option contract. These are Delta, Gamma, Theta, and Vega. There are other Greeks as well, but especially in terms of day trading options, the others aren't as important as these four. Among these four, I consider Delta and Theta to be most important to your day trading options. So what are these Greeks? Well, these are mathematical models that help you estimate how much your option price will move based on different variables presented. So you can think of the Greeks as independent variables, or X, as we learned in math classes, and the option price being the dependent variable, or Y. It's important to remember that the Greeks are constantly changing, and they're based on models, so they're not a fully accurate numbers. They'll just be an estimate of how your option price might end up looking. First, let's talk about delta. Delta represents the amount an option price is expected to move based on its underlying stock price rising by $1. The delta is greater the more in the money the option is than out of the money options. But as I'll show you in just 1 second, the percent change in option price is greater for those options that are slightly out of the money or at the money. And I'll show you what I mean. Here we have the option chain for Microsoft for options expiring on July 24th. We'll be taking a look at a few different options to compare the deltas. First, notice that delta increases as the more in the money you are. $1 representing for every dollar Microsoft stock goes up, these option prices will also increase by 1 at a 1-to-1 ratio. However, percentage-wise, it'll be greater for those options that are slightly out of the money. So if we take a look at the highlighted one, the delta is 15 cents. And let's divide that by the ask price. So for every dollar Microsoft increases, we can expect a 12.5% gain for this specific option if nothing else changes. Now let's take a look at the option that's more at the money or close to at the money. So for this one, delta is 0.46. We'll divide that by the ask price of 4.85. And now you get about 9.5%. Now let's take a look at more in the money option. Let's choose this one. So this one, delta is 0.85. We'll divide that by the last ask price, 14.45. And now it's 5.9% gain. So even though the delta increases the more in the money you are, you'll actually gain more percentage-wise if you are slightly out of the money and the stock ends up going in that direction. Continuing on with delta, also those options that have shorter amount of time left before the expiration date will have greater delta than those options with much longer period left on their option. Just know that for calls, delta will range from 0 to 1, and for puts, 0 to -1. This is to represent that for calls, the option value will increase if the stock price goes up by 1. So it's positive to positive ratio, versus for puts, the value of the option actually increases if the underlying stock price goes down. So it's an inverse relationship, and that's why it's negative. Next, let's talk about gamma. Gamma measures the rate of change of delta. In other words, if delta is velocity or speed, then gamma is the acceleration. Personally, I don't really use this in my daily option trading because one, it's already kind of represented in delta. 2, it's just too much information, especially for short-term trading. However, it is good to note that the largest rate of change, it happens near at the money. As the option goes farther out in either direction, the gamma decreases. So this is another reason why I tend to buy options that are slightly out of the money, because when I sell my options, I want them to be still peaking. In other words, if it's too in the money, then it's not generating the most percentage gain as it can. The third Greek we'll talk about is theta. Along with delta, this is the most important of the two Greeks. Theta is time decay. So a way to remember it, theta starts with T for time decay. Theta represents the amount the option price will decrease for every trading day as it goes towards the expiration date. Because of this, the value is always negative, and it's the buyer's enemy and seller's friend. If you buy an option, every day you hold that through, some value of it will come out because of theta. And if you sell options, every passing day, you're gaining a little bit of value. Note that the percentage decay is usually greater for those options that are out of the money. Theta starts to have much bigger impact, especially as it gets closer to the expiration date. As you can see on this graph, x-axis represents time and y-axis represents the theta value of the option. So for the majority of the period, the theta value, or option's time value, actually stays relatively similar, but once it crosses a certain point close to the option's expiration day, it starts gaining momentum and it plummets to the ground. Lastly, we have Vega. Vega represents how the option price may be affected by 1 point change in its implied volatility. So, a way to remember this, Vega starts with V and V for volatility, or how volatility will impact the option price. For all options, if volatility increases, then all option prices will gain in value, whether it's calls or puts. I don't pay too much attention to Vega specifically, mostly because volatility is relative to what the stock has been doing recently. And also, it's the only unknown variable in that I just don't know when the company will release some news or when there will be certain event except for earnings report. So how should you use these Greeks to help you with your option trading? 1, you should have a price target based on whatever methodology you use to predict the market. This can be based on any methodology. You should also have a rough estimate of time target, but this can be changed based on the next step. Once you have your target set, then compare the delta based on your target versus the theta based on the time target you set. If you consider that risk reward to be too great or too much for your taste, then you can roll over the theta, meaning push your time target farther away so theta eats away less at your option value. As I mentioned before, there are other smaller Greeks that may help you with your strategy, especially with more complex option trading, including selling options as well as using multi-legged option trading. Thank you so much for watching. I hope this has helped introduce you to option Greeks and using them to help you with your option trading.